Hey, how's it going, everyone? Welcome to Finance with Avrin. The IRS recently released their updated notice in regard to changes and updates for retirement accounts in 2026. So I'm going to break that down and give you the information about 401k, Roth IRA, traditional IRA, and other retirement account changes in regard to contribution limits, income phase outs, and more. Let's get right into it here. First, starting with the retirement contribution limit changes for 2026 for the following type of retirement accounts: the 401k, the 403b, the 457, and the TSP. So these are all basically employee-sponsored retirement plans. You get them through your job. So that kind of a retirement account. 401k is for private sector companies, 403b, nonprofits, public schools, hospitals, universities, 457, state and local government workers, and then TSP stands for Thrift Savings Plan. It's the federal equivalent of a 401k for federal government workers and military. Now, contribution limit for these type of accounts has increased to $24,500. So that's an increase of $1,000 from 2025. So let's just say, so to speak, if you invested $24,500 per year into an index that tracks the S&P 500, it's like basically the stock market, one of the main indexes, like, VOO, SPY, one of those ETFs or index that tracks, the S&P 500. So let's just say you put your total $24,500 every year in an index like that in your 401k or 403b or something like that. So the stock market has an average annual return of about 10%, 10.3% here and there. So that would be the amount that we're going to use as a percentage for those 20 years. So that maximum contribution limit every year for 20 years, you're going to have that account equal about $1.6 million here or there after that 20 years. So that's not just $24,500 times 20 years, the amount you're putting in there, because that's like $490,000. That's very different to around $1.6 million. That's all the growth just in 20 years. What about 30 years? Let's say you have more years to contribute. Same maximum contribution, same type of fund in one of these retirement accounts. For 30 years, that amount in that account is going to be around $4.4 million. So of course, this is saying that amount is staying at $24,500 per year, which is definitely likely going to change because of inflation. And so that amount that I'm giving you in these examples, of course, is not adjusted for inflation or anything like that. And then the catch-up amount for ages 50 and over increased by $500. So that contribution limit for that age group is now $8,000. And now the special catch-up contribution limit for ages 60 through 63, there was no change to it. It is still at $11,250. So that makes the maximum contribution limits for ages 50 and over at $32,500. And then for those ages from 60 to 63, the total contribution limit for 2026 is going to be $35,750. So those are the changes to the contribution limits for 2026 for those type of accounts right there. Now let's get into some information in regard to contribution limits for other type of retirement accounts like IRAs, individual retirement accounts. So your traditional, Roth, and simple IRAs. And now traditional and Roth IRAs had their contribution limit increased by $500 to $7,500 for the year of 2026. So let's say you contributed that max of $7,500 in your traditional or Roth IRA into a fund that tracks the S&P 500, some kind of index like that, low expense ratio, and just tracks the overall stock market in your Roth or traditional IRA. So of course you could diversify your accounts. I'm not saying just to do that. But that is a way that a lot of people invest. Just put it in the S&P 500 index like that, an ETF or something like that, and follow the stock market. The historical average annual rate of return on the stock market in an index like that is around 10%. So yeah, that's a nice amount right there. Of course, some years are going to be better than others. That's the average annual return. And so let's say you contributed that maximum amount of $7,500 in a fund like that in your IRA for 20 years. Well, after that 20 years, your account's going to be around $490,000, $500,000. And no, that's not 7,500 times 20 because that equals 150,000. So no, that around 500,000 of your account after 20 years is a lot of growth and a lot of compound action going on right there. So that is an example of, amount in 20 years. So what about 30 years? Because of course, the longer amount of time that you have to invest, the better. typically, historically, in the stock market. So for 30 years, same amount, same type of fund in your IRA, your balance is not going to be around $500,000 or so, something like that. It's going to be around $1.1 million. And yes, that's more than double the 20 years, even though it's not more than double the amount of years. That's that compound action going on and that growth. So yes, if you can contribute the maximum amount to an IRA, you'll definitely appreciate it later in life. And even if you can't contribute the maximum amount, any amount is definitely better than no amount. And of course, the more, the better. Some years you may be able to contribute more, some years not as much. And of course, those amounts I gave you weren't adjusted for inflation. So that amount is going to be worth less in that 20 or 30 years. However, I did just give that maximum contribution of $7,500, which is for, 2026. Likely that maximum contribution limit is going to raise, next year, probably, if not next year, the next year, something like that. And maybe the next year and the next year. So just a quick math example of investing that maximum amount in your IRA. And then the catch-up contribution special for ages 50 and older increased by $100. So that's now at $1,100. And so contribution limit for those under 50 is now at $7,500, and 50 and older is now at $8,600. Now that's for traditional and Roth IRAs. And now traditional IRA, individual retirement account, is a personal retirement account that you open on your own. You don't need an employer for this type of account. And now contributions to a traditional IRA may be tax deductible depending on your income and whether you or your spouse are covered by a workplace plan. And I'm going to get into those amounts in the next slide. And so typically for a traditional IRA, the money grows tax deferred and you pay taxes on it when you take it out for retirement. Now, Roth IRA is different than the traditional IRA, but it has a lot of commonalities, which the fact of it being an individual retirement account that you can open on your own without an employer. So that's the same. However, with a Roth IRA, you contribute after tax money. And so the big advantage of that is that all of that money in that account is growing tax-free basically. And so the growth and the dividends and all that tax-free. And so at retirement, when you withdraw from a Roth IRA, you get that money out tax-free. And now Roth IRAs have income limits though, meaning higher earners may not qualify to contribute directly to a Roth IRA. And now if you're a high earner, there is a way to get around that with a backdoor Roth IRA. I'll tell you about that on the next slide. And now a simple IRA is a retirement plan for small businesses. It's kind of like a light version of a 401k, where workers can contribute and employers can match or contribute to it as well. Now, the contribution limits for simple IRAs are lower than 401ks, but higher than traditional and Roth IRAs. And now under Secure 2.0, some employers can choose to offer an enhanced version of a simple IRA. And so they only qualify if they make higher contribution limits. So it's not available to everyone. And now the standard simple IRA contribution limit has been increased by $500 to now $17,000. And now the enhanced simple IRA limit was increased $500 to $18,100. And now the catch-up contribution for simple IRAs has increased for ages 50 and over by $500 to now $4,000. And then the special catch-up contribution limit for simple IRAs for ages 60 through 63, there was no change to that limit. It will remain at $5,250. So now let's get into some information about the income phase out ranges for a traditional IRA. And now traditional IRA deduction is a tax break you get for contributing to a retirement account. Now, when you contribute money to a traditional IRA, you may be able to subtract some or all of that from your taxable income for that year. And now an example of this, if you contribute $7,500 and deduct it, you pay taxes on $7,500 less of income for that year. So that deduction reduces your taxes now, for the next year, however long you got that going on, but you pay taxes on withdrawals in a traditional IRA upon retirement. So that's when you get hit with that tax bill in regards to getting that income taxed right there. So I'm going to be giving you phase out ranges on this section. And now if your income is in that phase out range, you only get a partial deduction, a gradual decrease, basically, not an all or nothing. So if you're in that range of income, then you won't be able to contribute the full amount, like a part of the amount. For example, if you're halfway in that range, then you'll only be able to deduct half of your eligible contributions amount from your taxable income. Now, if you're above the income range of that phase out amount, then you can still contribute to this traditional IRA, but the contribution is not deductible. Now, if you're below these income phase out ranges, then you can deduct the full amount of your contribution from your taxable income. Now, if you have a traditional IRA and you're covered by a workplace retirement plan, like a 401k or 403b, and you're single, your income phase out has an increase for 2026 by $2,000. So now the income phase out range is now going to be between $81,000 and $91,000. And now if you're married filing jointly and the contributor is covered by a workplace plan, that income phase out has increased by $3,000. So that range is now between $129,000 and $149,000 of income annually. And now if you're not covered by a workplace plan and you have a traditional IRA, but your spouse is also not covered by a workplace plan, there's no phase out levels and a full deduction is allowed. Now, if you're not covered by a workplace plan, but your spouse is covered by a workplace plan, then your income phase out range has increased by $6,000. So it's now between $242,000 and $252,000 a year. And now if you're married filing separately, but covered by a workplace retirement plan, then there's no change for your income phase out. It's remaining in that range from $0 to $10,000. All right, now let's go over the deduction income phase out ranges for Roth IRAs for 2026. And so for Roth IRAs, remember when you withdraw your money from a Roth IRA upon retirement, all of that money is tax-free because you're contributing money that's already been taxed into your Roth IRA. If you're single or head of household, that phase out income range has increased by $3,000. So that range is now between $153,000 a year and $168,000 a year of income. And so if you're married filing jointly, it has increased by $6,000 for that income phase out range. And so now that income phase out range is between $242,000 and $252,000. Now, if you're married filing separately, then there's no change in that deduction phase out. It's basically between $0 to $10,000. So those are the changes right there in regards to income phase outs. And so the same thing applies to the Roth IRA in regards to income phase out ranges with the traditional IRA. I spoke about that more on that slide that was previous to this one. It's going to be the same in regards to phase out ranges for the Roth IRA. So if you're below that income range, you can contribute the full amount. If you're within that range, then you can only contribute a partial amount proportional to where your income falls. And then if you're above that income range, then you cannot contribute directly to a Roth IRA. However, there is a method that you can go about to invest in a Roth IRA and being a higher earner. So you could do what's called a backdoor Roth IRA. The steps for this for a backdoor Roth IRA is that you will open a traditional IRA account and then you're going to contribute after tax dollars. And then you would convert those funds from a traditional IRA to a Roth IRA. Now you're going to want to report this conversion on IRS form 8606 to track your basis, the after-tax money, which helps avoid double taxation. You don't want that. Okay. If you're interested in that, definitely check out your brokerage you're with, Fidelity, Vanguard, Charles Schwab, whoever it is. And so now let's move on to the next section in this video here. There's going to be about the Savors credit income limits for 2026. So a Savors credit is also known as a retirement savings contributions credit, is a tax credit for low to moderate income workers who contribute to retirement accounts like a 401k, 403b, IRA, and so forth. This credit is different from a deduction. The deduction reduces taxable income. However, a credit directly reduces the tax you owe. So that's going to be a difference right there with regard to deductions and credit. Same as, your taxes, that you do every year. So now the Savors income credit limits have increased by $750 for those filing single. So that limit is now at $40,250. And now if you're head of household, then that limit has increased by $1,125 to now $60,375. And now if you're married filing jointly, that limit has increased by $1,500 to now $80,500. And that's the info right there on the Savors credit limits for 2026. And that is my video, everyone, on the IRS retirement account changes for 2026. And if you enjoyed the video, be sure to like it down below and subscribe to the channel for more ways to make your money work harder and smarter for you and some of the latest news in regards to personal finances. Hope you all enjoyed the video. Take care.